The financial sector balance sheet is in decent shape. This is something we talked about in the last scouting report. This is the financial sector debt to GDP. Looking at a 5-year Z-score basis, which is going back to that the four horsemen of economic risk, that leverage cycle analysis chart. When you look at it on a 5-year Z-score basis, if you saw a +2 here, this is the credit growth. That'd be the x-axis, is the y-axis in that chart. +2 here, you'd be up to the right. That'd be a problem, right? But we're not quite up +2 and +2. We're almost +2, and from a rate shock perspective, but we haven't seen that kind of growth in credit that will create the bigger problem in terms of the unwind of the leverage. Same thing with the household sector balance sheets, in decent shape as well. Not getting the +2. You're getting basically the zero, minus 0.5, and the +2, which again is that's positive relative to an expectation that we got to go into recession. Debt service is not yet an issue for U.S. consumers. So what this chart shows is household debt to total income. Looking at breaking it down: mortgage, HELOC, auto debt, credit card debt, student loan debt. This is debt to income, not debt to GDP, debt to income. So this is the corporate U.S. consumers' ability to service that debt. We're at 87% debt to income. We're basically right where we were in the pre-COVID economy. So very clearly, as much as inflation has been a problem and it's clearly obviously hurt lower income consumers relative to upper income consumers on a broader aggregate basis, it's not really doing that much in terms of restricting consumers' ability to service their debt. So that's positive at the margin from the perspective of the economy. Another thing that's positive at the margin is that this economy is with positive and negative. It depends on what direction the stock market's going, but it's this hyper-financialized U.S. economy is more sensitive to asset markets than ever. And what I mean by that is if you look at the share of private non-financial sector credit that is on bank balance sheet, it's only at 32%, which means that the shadow banking sector is accounting for, the other, let's call it 70-ish% of private non-financial sector credit. That compares to, roughly around 50% for Europe and roughly only around 20% for China. So this is a very hyper-financialized U.S. economy that is very sensitive to credit spreads, very sensitive to stock market. That's what makes the economy go. It used to be that, hey, you forecast the economy to predict where the markets are going, but now that process is a lot more reflexive. You don't understand where the economy is going based on looking at the market, and ultimately you can understand where the markets are going based on looking at your projections for the economy. So that's a much more tighter, reflexive process, which is partially why you saw the improvement in a lot of economic statistics in July relative to June, and in August relative to July. So will that improvement continue? We're going to need to see positive outcomes from the perspective of the asset markets for that to continue. This is partially why, again, the improvement in financial conditions that we've seen, the easing of financial conditions we've seen off the June lows, is partially why indicators of financial stress are declining. So this is data from the New York Fed Survey of Consumer Finances here, the July data. And what we're showing here on the right side of this chart is looking at the percentage of respondents who are expecting to miss a minimum debt payment over the next 3 months. This is the under 50,000 cohort from an annual income perspective, 50 to 100,000 and over 100,000. As you can see, we're moving in the right direction. It's 16.6% in July. It's actually down from 17.3% in terms of low-income consumers expecting to miss a minimum debt payment. We're actually down in terms of median income consumers and way down in terms of upper income consumers, which actually makes the most sense, right? These are the people who own all the stocks and credit in the economy. One thing I'd also call out is that relative to the pre-COVID trend, we're actually better than we were. With all this inflation, you would expect investors, or not investors, consumers, to be a lot cash strapped. They're not cash strapped. They're telling you it's actually better today than it was in the pre-COVID era, because again, all this credit is nominal. We're talking about nominal economy now. Now, real versus nominal, I think that spread between how you think about the asset markets is actually widening in terms of real versus nominal. It used to be all kind of the same thing, but now we have to start looking at certain different indicators like this to understand the impact of some of these nominal dynamics upon the broader economy, upon corporate earnings, because again, it's not this linear relationship that it used to be in terms of real versus nominal. So this is something I definitely wanted to call out, because again, it kind of pushes back on this view that consumers are strapped and everyone's falling off the cliff in terms of debt serviceability and et cetera, et cetera. That's just not true when you look at the actual data. Reminder, U.S. households have $3 trillion in excess savings. I pause for dramatic effect. I mean, this is literally relative to the pre-COVID trend. We have $3 trillion in excess savings, $4.5 trillion in total savings. If you look at cash and checkable deposits on U.S. household balance sheets, it's extra $3 trillion relative to the pre-COVID era. So again, consumers are flush with cash. They're obviously pissed off from a consumer confidence perspective because their wages are not keeping up with the change in prices. But it's still not the end of the world. I mean, they still have all this cash on the sidelines. You look at total net worth, just nominal net worth, 149 million, big excess relative to the pre-COVID trend. And then you look at net worth as a percentage of disposable personal income at 818%, or it's basically a ratio of 8x of disposable personal income, very clearly in no man's land to the positive side of the ledger on this chart. So the U.S. household balance sheet is good. There's no way ifs, ands, or buts about it. It's a good balance sheet, and it's allowing consumers to weather the storm from an inflation perspective. This is why consumer spending is hanging in there. 0.6% 3-month annualized real PCE growth through the month of July. Nothing to write home about, but it's growing. It's growing at a time where most bears don't think it's growing, quite frankly. Obviously, services, the spread between services and goods is really, keeping the broader aggregate positive. Clearly, we spend more on services. I think it's about 2/3 is consumer spending. Actually, no, services is 3/4 of consumer spending. Goods is only a quarter consumer spending. And then real disposable personal income. Now that we're starting to see inflation slow, we're actually starting to see income rise on a real basis. Again, 0.1% is nothing to write home about, but it's no longer deeply negative as it had been for much of the past kind of 12 months. And then partially one of the reasons we're seeing consumer spending hang in there is that the personal savings rate has gone down. But this is a flow statistic. This is how much are you saving relative to the incremental money you've got from an income perspective. Going back to this chart, this is a stock statistic. This is just how much cash do you just have in your bank account. So this slide 106 kind of leads you into why we have not such positive, but why we have better than expected dynamics here on slide 107 from a consumer spending perspective. And then just kind of shifting gears, looking at U.S. corporates. So they're flush with cash as well. So you got, $2.3 trillion of cash on corporate balance sheets as well. You look at cash as a percent of overall corporate debt at 7%. That's above trend as well. And then lastly, cash as a percent of the corporate GVA gross value added for the domestic private sector, which again is the broadest measure of income for the private sector, non-financial corporates. We're still above trend there as well. So not quite as flush with cash as U.S. consumers are, but certainly above trend from that perspective. And that to me is something that's also been positive for the economy. And one of these, can you put the mosaic together? Okay, why is the economy doing better than I think we all thought it would be doing? Let's call it 6 months ago in October, in June, July, and August. The reason it's doing better than what we thought it would do is very clearly because, again, balance sheets, at least from a cash perspective, a liquidity perspective, are actually hanging in there quite well. And then lastly, the resilience of the U.S. economy should not be underestimated. So what I'm showing here is Retail Sales Control Group. This is data through July. The August report should come out next week, accelerating on a 3-month annualized basis to 9.2%. Industrial production slowing on a 3-month annualized basis, but at 1.9%. It's actually higher than the pre-COVID trend. Again, this is a 2015 to 2019 trend. Now, albeit we did have 2 industrial recessions in there, one led by energy, another one led by the Trump tariffs. But again, we're still growing it. This is a volume. This is a nominal statistic. This is a volume statistic. Both of them are growing. And they kind of rhyme with what we're seeing from a monthly GDP perspective. So Bloomberg and Macroeconomic Advisors have this monthly GDP statistic that uses the same methodology that the BEA uses, and that's 9.2% through July, 2.6% through July on a real basis as well. So these things mirror each other. And guess what? Neither of them say the economy is in recession from a growth rate perspective.